Welcome to the Commercial Real Estate Show, your source for market intelligence, forecasts, and success strategies. Hello, I'm Michael Bull. Thanks for joining us on one of the radio stations, iTunes, YouTube, or the show website, creshow.com. Well, today we have an exciting show for you. We're going to talk about retail, a retail market update and forecast for 2017. Retail has been a little bit of a bumpy ride depending on the type of property and assets. We've seen a bunch of store closures. We've seen good performance. We've seen bad performance. And then we have some changes potentially in the economy moving forward. So we'll talk to some experts, get an idea of what to expect. Please welcome my first guest, Barbara Denham. She's senior economist with Reis, and she's joining us on the phone. Barbara, thanks for being with us.
My pleasure.
So, Barbara, talk to us about how last year finalized. What did you see for performance of retail properties around the U.S.?
Well, we definitely saw some things that raised a little bit of caution. A number of metros posted rent declines in the fourth quarter, 15 to be exact, 15 out of 80 that we track, and 25 metros increased vacancy rates. So I think we're starting to see a clear correction in the retail property market. 30 metros showed an increase in vacancy over 2015. And this is neighborhood and community center shopping centers. In the malls and the power centers, we're seeing similar statistics, increase in vacancy rates and flat rents for the year end.
So give us some examples to get an idea. So how much did vacancy increase?
Well, the vacancy rate nationally only increased 2%, 0.2%. But, for example, of the metros it's basically an average of metros that did well, metros like San Diego, Tucson, Baltimore, and some of the Florida and Texas markets, and those that didn't do very well, like Little Rock and some of the smaller markets across the U.S., Oklahoma City, Greensboro, Sacramento, those things. So it's really an average. There's not a real glacial movement in the retail property market. People think there's this major change, and things just don't move that way. They move very, very gradually. In fact, we track store openings and store closures by property, and we are seeing almost as many store openings in many of these shopping centers as we are store closures. And most of the stores that are opening are interesting food stores and restaurants.
And that's good news, especially because what we hear in the general news is just the closings, right?
Yeah, exactly. So there is good news that
Right.
that isn't getting reported.
Right. So what about rental rates? What did you see overall in the U.S. for 2016? What happened?
Well, the rent rates in general went up by about 0.4%. So that's not bad. That's a quarterly increase rate, and the annual rate was about 1%. So again, not major movements. Definitely a deceleration from past years, but it's not negative. Again, it's an overall national average, so many markets are still doing fine. It's the ones that are lagging that are pulling the average down, but they're only pulling it down by 0.1%, 0.4%. Nothing seriously raising concern. Definitely a correction, but nothing. Nothing so eye-opening that you would expect that the media is reporting. In fact,
Right.
we also track employment growth. And what we're seeing is even though a number of metros are reporting retail employment declines, there's a lot of restaurant growth in many of these metros. So I think about 8 metros show employment declines from last year, but that's not many. And even those declines are less than 1%.
Right, and they will impact retail, and so will housing. So
Yeah.
we're talking with Barbara Denham, a senior economist with Reis, about retail real estate. And so what do you expect moving forward, Barbara, for performance in 2017? It seems like there's some potential good news and some headwinds.
Yeah, there's both good and bad. Of course, the new administration, there's all the uncertainty has come from the new administration and what impacts it will have on, say, trade wars and inflation. A lot of people expect him to follow through on the infrastructure investment, and that will raise economic activity, jobs. but it will also raise inflation and debt levels. So that will have both a positive and negative impact on retail. If there is some kind of a trade war, we're going to see it'll benefit retailers to some extent because e-commerce channels might be affected. However, it will probably mean higher prices, and that will dip into purchasing power for consumers.
Okay, and then what does that mean on the real estate level for retail properties as far as rates and occupancy rates moving forward in 17?
Well, I think right now, a lot of retail property markets, developers and landlords are very fearful of the future just because of the e-commerce stories and the store closures. So I don't see anything improving in 2017. Some metros, again, are still doing fine. As long as job growth is positive in these metros, and it is, the retail market should hold its own. In other words, it won't see major declines. It might see, again, a 0.2% decline in asking rent and an 0.3% increase in vacancy rate. We're definitely seeing, all the clear signs of a correction in a number of metros, but it's not a glacial movement. It's just a very, very subtle movement. So what we've seen in the fourth quarter is what we're expecting to see in 2017, which is, again, about 20 out of 80 metros probably posting vacancy rate increases and rent declines, but the majority, 3/4 of which, will probably see occupancy growth and very, very small rent growth rates.
Okay. And are there a property type or sector inside of retail that might perform better in 2017?
Well, believe it or not, the neighborhood and community shopping center, which is the nuts and bolts of what we report on, are doing well because those are the kind of necessary retail formats where, the hardware stores and the delis and the pizza places and Chinese restaurants. Those are doing well. The power centers are the ones that raise concern. They have the Walmarts, the Kmarts, the Dick's Sporting Goods or the Sports Authority, whereas, and the malls especially, are raising a lot of concern because if you have major store closures in an anchor, it just casts a dark cloud over the whole property itself. So you might have less foot traffic.
Right.
So in that order, that's how we're seeing things.
Right. What about cap rates for 2016? What were some sample cap rates, and how did they move?
Well, cap rates are driven by the transactions that close. So when you see investors buying the best properties, you're not necessarily going to see a increase in cap rates. That being said, we did see a slight tick up at the end of 2016, very, very slight increase in cap rates, which means that the risk premia attached to retail purchase is a little higher. So the transaction volume is much lower than it was a year ago, so you're not seeing a lot of trade activity. So again, that will affect the volatility and the actual cap rate because you're probably seeing better properties traded. But a lot is driven also by the interest rates, and the 10-year bond rate jumped right after the election, and that will affect cap rates both in a positive and negative way in that the risk premia has gone up, but then you have fewer investors that would buy a retail property because, they'll get a better rate in the treasury market. And then, of course, the 10-year rate has declined in the last month or so. So it's just a lot of volatility going forward. That volatility is probably here to stay for the 2017 period. But where cap rates go, probably up a little bit more, but not major jumps unless the inflation rate goes up considerably.
Right, and we're short on the break, but if cap rates rise a little bit in retail, is that mainly from an increase in interest rates, or is it also some of the volatility in the bricks and mortar retail?
Well, it's a little bit of both, and I think it is just a risk premia issue. So buyers will be lowering their purchase price because they will demand a higher risk premia, which means the cap rate will go up. And interest rates probably will reflect both the risk premia and the lower purchasing price because it means the borrowing costs have gone up.
That's great. Well, Barbara, thanks for joining us. We appreciate you being with us and sharing your insight.
My pleasure, Michael.
And if you'd like more information from Barbara, visit Reis.com. That's REIS.com. Well, we're going to have some more on the retail and retail real estate, including a look at the REITs. That's a great way to invest in retail properties, get the diversity of commercial real estate, but also have liquidity. So we'll get some experts in and talk about that and what to expect moving forward. Be sure you connect with us on Facebook, LinkedIn, and Twitter. You can find them all at our website, CREshow.com. Stay tuned. We'll have more on retail. This is the Commercial Real Estate Show. I'm Michael. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.